Hello, YouTubers. Hello, Forex traders in particular. This is your boy Shella. Thank you for taking your time to view this video. Hope you learn a lot from what I'm gonna talk about today. And today I just wanna talk about hedging an account to save yourself from being blown out of the market. So when you hedge, firstly you need to understand what is the trend doing, where is the market going, in the long run, what's going to happen in this market. So the first thing, let's just define a trend quickly and identify where this market is likely to go. As you can see, I've already drawn my support and resistance. I'll quickly draw trend lines to just to show where this trend is, what the trend is doing. Now I pressed the wrong thing here. Oh man, let me just do this. So as you can see, the trend is going up. As we can see, the market is making higher highs, higher lows. So from here, this point at a price of 110.984, we're expecting the market to be supported and hopefully go up. As we can see, the market has supported the first time the market shot up. It's now coming back. So my take on this market is it's going to this market is going to hopefully make a double bottom and then shoot back up, but we'll see what the market does. I mean, it's not restricted to my analysis of a double bottom. It can continue going down, go down to whichever level it wants to go to. So we just have to respond to what the market is doing. We don't really need to know where the market is going, but the important thing is to respond to what the market is doing. So now I'm going to talk about hedging. Since we know what the trend is doing and we can see our support and resistance lines, I'm quickly going to remove these trend lines so that we can see what's happening on the chart. Okay, let me put this back on, put this back here. So now what is hedging? So hedging is selling and buying a market at the same time. So when you buy and sell the market at the same time, what you are doing is holding that price difference locked in. So from my selling point at this price here at triple 1.093 to here triple 1668, I've logged in a loss of 57 pips roundabout there. So that's what hedging is. You lock in the price difference between your sell your buy order and your sell order. So whatever that market is, I mean whatever the price is between those two points, will forever be that difference. It doesn't matter whether the market goes up to infinity, the market goes down to infinity, the market will forever be, if you are losing $10 between these 2 points, your sell and your buy, wherever the market goes, you will forever lose that $10. If you are in profit of $10, wherever the market goes, whether up or down, forever you will forever be in a $10 profit. So what happens is the reason to hedge the market in a situation like this is to, as you can see, in my situation, I was buying the market here thinking it's gonna continue going up as I've analyzed what the trend is doing. So unfortunately the market only put me in profit for a day, and then second day it came back down against me, third day, and I was still holding because I believe this market will be supported here. So I wasn't scared of the market going against me because I believe it will bounce back from this support line and continue going up. So it went a couple of days against me. I was fine with that. um, so now yesterday when I saw the market coming at this level at 111 comma 014, I thought, oh, maybe this market wants to continue going down, so let me just sell this market and hold the loss that I have between these 2 points, because wherever the market goes I'll forever have this loss. It will never change. So now what I'm waiting for is the market to either break out of this break down below this support line, go back up, down, sorry, come back, retest this, and then after it comes back to retest this level of support, turning it into resistance, I know the market is more likely to push down. So now with my hedge positions, I can now put in another sell order to close down the gap of the loss between the buy and the sell order that I have here between these positions, and then that second sell order will put me back in the money, and I'll write the market down to 10973, reversing, um, just simply reversing the loss I have between uh, these two these two open orders. And another thing I can do is to see uh, when the market puts me in profit on this sell order, because I still believe this market will bounce. I will get supported here and bounce up. So when this market goes into profit, I can easily close this sell order, and I've bagged some money to my account to increase my strength in the account, and then put in a buy order when I see that the market is going up, and then now have two buy positions that are gonna put me in the money, taking the market up. So that's another way I can deal with this um, situation. So in hedging, you just have to see what the market is doing, what is the market more likely to do, and you just respond to what the market is doing. You don't really necessarily have to know where the market is going, but you just need to respond to what the market is doing. So with this skill or strategy, you can reverse any loss you might incur on your trading account, because now the loss that I have here is locked in. So I'm never scared anymore that, man, heavy news might come out and there'll be a huge candle here that will just pull me out of the market. I know I have this sell position that will be in profit should the market continue going up. And I know should the market turn around and go up, I have a position that will put me in profit. And I'll add the second position to put me more into profit and close down this sell position that will be in a loss if the market goes up from this point. So hedging can be really useful, helpful if you're account is in danger of being blown out, you can just hedge the market and reanalyze the market to see where it's going. Hold those two positions, put in a third position that will put you in the money, and to reverse the loss that you might have been exposed to in the market. But firstly, before you can reach this level, you need to trade safely. Do not over risk your account, because when you over risk your account, you won't be able to hedge the market, because you're just gonna cause a disaster in your trading account strength, especially. And you have to be careful of opening too many positions. You find that you are too scared when the market goes against you. So you should always trade at a safe position size, and so that when the market goes against you, you are never scared. No matter how far it goes, you continue believing in your analysis and what you see the market is going to do. So with that said, thank you guys for your time. Thank you for uh, tuning into this video. I hope you've learned something and hopefully can help you in your trading. Thank you so much. Enjoy your trading. Trade safely. That's one thing that will help you to survive in this market. Never over risk your account unnecessarily. Do not be greedy. Thank you. Peace.